Welcome to our deep dive on the retirement tax time bomb and why many high-earning young professionals should rethink heavy Roth contributions. To set the stage, we will first define the concept of bracket arbitrage. Then we will compare traditional, Roth, and taxable accounts. And finally, we will build a practical, diversified plan that balances tax efficiency with flexibility. Along the way, we will use simple math, practical steps, diagrams, and quizzes to make sure you can apply this immediately. Now, let's begin by outlining today's roadmap. Here is our agenda. First, we will cover the cold math of tax arbitrage. Next, we will explain why heavy Roth contributions can be costly early in a high marginal bracket. Then, we will introduce the three-bucket strategy to build tax diversification. After that, we will walk through step-by-step how to do bracket arbitrage in practice. Subsequently, we will examine a short case study and consider allocations. Finally, we will review key takeaways and an action plan, followed by a brief wrap-up. To start, consider the cold math of tax arbitrage. If your combined federal and state marginal rate is near 30%, each pre-tax dollar reduces your current tax bill by roughly 30 cents. That is a guaranteed, risk-free return created by the tax code. By contrast, contributing the same dollar to a Roth in a high bracket sacrifices those immediate savings for the uncertain hope of lower lifetime taxes later. Therefore, when your marginal rate is high, prioritize pre-tax to capture those immediate savings. Then, as we will show, redirect those savings into a flexible taxable account or toward high-interest debt to build both flexibility and net worth. With that foundation, let us examine why Roth can be costly early in a high bracket. Why can heavy Roth contributions hurt in early high-earning years? First, you give up immediate tax savings close to 30%, which you could otherwise invest or use to pay down expensive debt. Second, high-earning years are the most valuable for pre-tax deferral because they generate the largest tax reduction. Third, the Roth bet pays off primarily if your future effective tax rate is significantly higher than it is today, which is uncertain and often not the case in retirement when income is lower and deductions can apply. Fourth, you do not have to abandon Roth entirely. You can maintain Roth exposure via roth-ira contributions, employer match in Roth if available, or by planning strategic Roth conversions in lower income years. Next, let us get practical with a clear, step-by-step approach to bracket arbitrage. Here is the bracket arbitrage playbook. First, maximize your traditional 401k or other pre-tax account while your marginal rate is high. Second, quantify your immediate tax savings through increased refund or reduced withholding. Third, automatically redirect those savings into a taxable brokerage account or to accelerate high-interest debt payoff. Fourth, invest the taxable account tax efficiently using broad index funds and consider tax loss harvesting where appropriate. Fifth, maintain Roth exposure via a Roth-ira, possibly through a backdoor method if eligible, and plan future Roth conversions during lower income years, such as sabbaticals or early retirement. Sixth, reassess annually as your income, state taxes, and policy landscape change. With the process in place, let us visualize the overall strategy. The three-bucket strategy balances tax treatment and access. The traditional bucket reduces today's taxes and is typically the largest for high earners. The Roth bucket serves as a hedge against future rate increases and offers tax-free qualified withdrawals. The taxable bucket provides crucial liquidity and control before age 59 and a half, enabling early retirement bridges or major purchases without penalties. In practice, a balanced allocation across these buckets reduces the risk of adverse future tax scenarios. Next, we will translate this framework into an example allocation. This diagram illustrates a diversified allocation across the three buckets, for example, 40% traditional, 40% Roth, and 20% taxable. The aim is not to hit these numbers precisely, but to maintain meaningful balances in each tax treatment. This balance hedges against unknown future tax rates, improves withdrawal flexibility, and can reduce lifetime taxes by allowing you to pick where each withdrawal comes from based on the tax situation in a given year. Now, let us compare the buckets feature by feature. This table contrasts the three account types. Traditional contributions are tax-deductible today but taxed at withdrawal and may be subject to required minimum distributions. Roth contributions do not receive a deduction today, but qualified withdrawals are tax-free, and Roth IRAs have no required minimum distributions. Taxable accounts are taxed on dividends and realized gains, but they provide complete accessibility at any time, with capital gains due when you sell. Each bucket excels in different areas, so diversification across them is valuable. With the comparison in mind, let us see a brief timeline and a numerical case study. Consider a simple example. If your marginal rate is 30%, a $1,000 traditional 401k contribution reduces your current tax by approximately $300. If you automatically redirect that $300 into a taxable account or use it to pay down high-interest debt, you immediately improve your cash flow and long-term compounding. At a 7% assumed return over 30 years, that $300 invested could grow to roughly $2,280. Simultaneously, the original pre-tax contribution grows tax-deferred and will be taxed later, potentially at a lower effective rate. This combination demonstrates bracket arbitrage. You harvest guaranteed savings today and deploy them for growth or debt reduction. Next, let us test your understanding with a short quiz. Quiz time. If your combined marginal tax rate is around 30%, is prioritizing Roth contributions always the best move? Here are your options. A. Yes, always. B. No. Pre-tax can be superior when your current rate is high. C. It makes no difference. D. Only if your employer offers a match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. No. Pre-tax can be superior when your current rate is high. The reason is that pre-tax contributions deliver immediate, risk-free savings which you can redeploy into a taxable account or debt payoff, improving both flexibility and compounding. Now, let us continue with a second quick question on the three-bucket strategy. Second question. In the three-bucket strategy, why is the taxable brokerage bucket so important? Options are: A. It avoids all taxes. B. It provides liquidity and control before age 59.5. C. It guarantees higher returns. D. It is required for employer matching. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The taxable brokerage bucket provides liquidity and control before age 59.5. It allows you to access funds without retirement account penalties and to control the timing of realizing gains for tax purposes. With the quizzes complete, let us dispel a few common myths and clarify the realities. Let us compare myths and realities. First, the idea that Roth is always superior is incorrect. Your current marginal rate strongly influences the optimal choice. Second, taxable accounts are not just for traders. They provide essential liquidity and control. Third, while pre-tax defers taxes, it does not necessarily increase lifetime taxes if you plan withdrawals and conversions intelligently. Fourth, you are not required to commit to a single bucket. Diversifying across tax treatments reduces risk from policy changes and future rate uncertainty. Next, because financial decisions are personal and context-specific, let us share a brief disclaimer. Disclaimer. This video is educational and does not constitute financial, tax, or legal advice. Your situation may differ materially based on income, deductions, state of residence, employer plans, and goals. Tax laws can change, so review your plan periodically with a qualified professional. Any assumptions about returns, brackets, or time horizons are examples, not guarantees. With that in mind, let us reinforce the core concepts with clear key points. Here are the key takeaways. First, prioritize pre-tax contributions during high marginal tax years to capture guaranteed savings. Second, redirect those savings into a taxable account or high-interest debt payoff to build flexibility and compounding. Third, maintain Roth exposure to hedge against future rate increases. Fourth, construct a three-bucket plan spanning traditional, Roth, and taxable. Fifth, consider balanced allocations such as 40, 40, 20, and adjust as your income and goals evolve. As a final visual, let us quickly map the cash flow of bracket arbitrage. This sequence diagram shows the movement of money. Your paycheck sends pre-tax contributions to the traditional 401k, which reduces taxes to IRS and state authorities. The reduced taxes either increase your refund or lower your withholding during the year. Those savings are then automatically transferred to a taxable brokerage account or used to pay down high-interest debt. The result is improved flexibility, better compounding, and a stronger overall plan. To conclude, let us summarize and set your next steps. In summary, use pre-tax accounts when your marginal rate is high to capture immediate savings. Build tax diversification by funding traditional, Roth, and taxable buckets. Reinvest your tax savings into a taxable account or debt reduction to enhance flexibility and compounding. Maintain Roth exposure through IRAs and strategic conversions in lower income years. Finally, reassess annually as laws and personal circumstances evolve. Before we close, here is a friendly request. Thank you for watching. If this video helped clarify your retirement tax strategy, please like the video, share it with someone who needs it, and subscribe for more practical planning content. Finally, tell us in the comments how you currently split traditional, Roth, and taxable, and what you plan to adjust after today's insights.